Every major Bitcoin rally since 2023 began with the same signal. A weekly candle closed back above the EMA 50. And right now, that signal just fired again. The RSI is sitting on its multi-year support. And the MACD, which is the momentum indicator that shows when trend strength flips, has just entered the same reversal zone that marked every explosive move in this cycle. Each time this setup appeared, Bitcoin cooled off for a few weeks and then ripped higher. And now it's happening again, right as global liquidity starts to flood back in and governments are throwing money around like it's 2020 all over again. So in today's episode, I'm breaking down why this setup matters, how close we are to the next expansion phase, and the catalyst behind it. I'm super excited for today's show. And make sure you stick around until the very end because I'm going to be revealing what I believe is the fastest horse in this game, the strongest narrative in crypto right now. So let's get into it. All right, so let's start with what the charts are actually showing us right now, because Bitcoin just completed its third full correction of this cycle, roughly a 20% pullback from the $126,000 high, and it's now stabilizing above its long-term trend line. That level has quietly acted as the backbone of every major uptrend since 2023. We've seen this rhythm before too. Price cools, momentum resets, and then starts coiling for the next move up. And right now, the indicators are lining up the same way they did before every major leg higher. The RSI is still holding its multi-year base, and the MACD has flattened right where it did before the last three expansions. Each of those reversals produced enormous moves. When the MACD flipped bullish in 2023, Bitcoin rallied about 178%, from 16,000 all the way up to 46,000. And the next crossover in October of 2023 triggered a 120% surge, from 27,000 to 60,000 by spring. And in May 2024, the same signal preceded a 90% climb, from 63,000 to 120,000. Within months. Now that same setup is forming again. And historically, when the MACD turns from this zone, Bitcoin tends to gain anywhere between 80 to 180% over the following quarter or two. So structurally, the chart looks like a market catching its breath after a strong run, which is normal once again. If history continues to rhyme, as it likes to do, we know, this reset could be the launchpad for the next major expansion. So all right, now that we know the structure looks strong, let's talk about what's happening under the surface, and that is demand. For the first time in a month, Bitcoin's 30-day apparent demand has turned positive again. That shift alone is a big deal because demand usually flips before the price does, and the impact has showed up very fast. The entire crypto market added over 150 billion in value in a single day. Moves like this do not happen in weak markets. They happen when capital starts flowing back in again, because traders and investors have reason to believe the market's going to go up. Otherwise, they wouldn't be throwing their money in. And traders are already watching key technical levels of confirmation. And we see Bitcoin has already dipped to around 104.7 thousand, filling the CME gap that opened last week between 104 and 105,000. So that retest adds strength to the structure, showing that buyers are stepping in as liquidity resets. And when you zoom out, the on-chain data adds more depth to this picture. According to Glassnode, for instance, Bitcoin has rebounded from the 75th percentile cost basis right around $100,000 and is now consolidating near $106.2 thousand. The next key area sits at the 85th percentile level, around 108.5 thousand, which has historically acted as resistance during recovery phases. So in other words, we're sitting in the transition zone, where momentum typically rebuilds before expansion. Everything lines up too. On chain, on the charts, and across flows. Capital is coming back online, and demand is quietly rebuilding beneath the surface. So now let's get into why a fresh wave of liquidity is about to hit the system and what may very well kick off the bull run we've all been waiting for. The Senate just voted 60-40 towards advancing the bill ending the 40-day government shutdown. That means the Treasury is about to start releasing billions of dollars that have been sitting frozen in the TGA account. And at the same time, we know quantitative tightening ends in just 3 weeks. And to top it all off, President Trump has promised a 20 trillion economic injection stimulus, which I knew was going to happen. I was talking to everyone in my circle, my life, saying, "Come on, guys! Like there's gonna be a stimulus check. It's Trump." He's also introducing something called the tariff dividend, which is a $2,000 payment for every American adult, totaling roughly 400 billion in direct checks. This combination of government spending and fresh cash in circulation is the kind of fiscal fuel that can reignite global markets fast. When this much liquidity hits the system, it looks for opportunity. And Bitcoin has historically been one of the first assets to benefit. And then it trickles throughout the rest of the crypto market, we know. And institutional players are already positioning for that next phase of the cycle. We see that Strategy just added another 487 Bitcoin worth nearly $50 million, extending its position while prices remain in consolidation. And at the same time, Coinbase is launching a new digital token offering platform with Monad, the most anticipated layer 1 blockchains, which is also set to be one of the first projects to be listed. And over in traditional finance, the Depository Trust and Clearing Corporation, or DTCC, has listed 5 spot XRP ETFs. That is Bitwise, Franklin Templeton, 21 Shares, Canary, and CoinShares, all under its active and pre-launch category. The DTCC is the backbone of U.S. securities settlement, processing nearly all stock and ETF trades on Wall Street. So all of these developments point in the same direction. Institutional infrastructure for on-chain assets is deepening fast. So what started with Bitcoin and Ether ETFs is now expanding across the broader market. And Coinbase and the DTC are effectively laying the new rails for compliant tokenized assets to trade at scale. So as liquidity returns to the market, a new kind of pressure is building, not from traders, but from governments. The Bank of England, we see, is moving to cap stablecoin holdings at £20,000 per year. And the EU's AMLR framework just banned cash payments over €10,000, while mandating full ID verification for all crypto service providers starting in 2027. These are not isolated moves. They're part of a broader effort to monitor and control how capital moves as Bitcoin rails begin replacing the old financial system. The pattern is clear. Limits on cash, KYC on crypto, and new digital ID systems are on the horizon. And while regulators tighten their grip, open networks like Bitcoin and Ethereum keep expanding. Every new restriction pushes more builders and capital towards decentralized systems that can't be easily censored. That's why the privacy narrative keeps heating up. It's becoming a structural necessity, and we're seeing that shift in real time. Privacy assets are leading the move. Starknet, we see, which was built by the co-founder of Zcash, has seen stronger inflows than any layer 1 or layer 2 network except for Arbitrum. And at the same time, coins like Zcash, Fido, and Monero are climbing CoinGecko's trending list. The market is clearly testing where the next major narrative will form, and programmable privacy is emerging as the frontrunner, a continuation of the old ZAC trade, rebuilt for the layer 2 era. But rotation never happens evenly. The RSI heat map shows just how fragmented this phase is. Some assets are overheated, while others remain deeply undervalued, which is exactly how early rotation periods tend to look. And right now, the smart move is to focus on where real liquidity is flowing. In a market like this, the strongest projects with genuine use cases, especially those building privacy infrastructure, are the ones attracting capital first. So as we close out the video for today, we know that right now, crypto may feel quiet. Social interest in Bitcoin is sitting near cycle lows, so it hasn't really heated up yet, which is actually good news, considering how much incredible updates and bullish news events are coming to the crypto market. It means we're early because that silence has always been the sound of accumulation. Smart money and institutions are buying while the crowd looks the other way. So when they finally do turn in this direction towards crypto and Bitcoin, you will be ahead and you will benefit from their new liquidity. I hate to put it that way, but it's true. And we see that the charts, on-chain data, and macro signals all point in the same direction. Bitcoin's reset is complete. Every expansion begins like this, quietly, almost unnoticed. And once liquidity flows and sentiment catches up, this setup could drive the next major rally towards 160,000 to 180,000 by early 2026. So stay calm, stay focused, and keep showing up. The work you're doing now will pay off. We're gonna make it. So if this breakdown helped you see the bigger picture, feel motivated, feel inspired, and confirmed in your decision to hang tight and hang steady, then like the video and share it with someone who needs to hear this. And then of course, subscribe if you haven't already so you don't miss the next move, you don't miss my next video. I love you guys so much, and I'll catch you guys here in my video tomorrow. Take care.